Absa Asset Management believes our equity market is not aligned with the underlying economic fundamentals. For more, we're joined by Craig Pheiffer, General Manager at Absa Investments. Welcome, Craig. And I think you said that applies to the global market. We've got plenty of bad news, but the equity markets just don't reflect that.
Well, I think if you look, we've seen this week the S&P 500 making multi-year highs, our own market flirting with all-time highs as well around these levels. So the markets themselves don't look in too bad shape. And they have had a good run. But if we look at the underlying, the economics, we seem to be reducing our growth forecasts across the board, for the global economy and for individual economies. China, I know we've also just reduced that again to about 7.5% for this year and something similar for next year.
So is this all about the liquidity, the bond buying, capital injections?
Yes, I think we've seen a few probably similar instances in history, that greenhouse effect with too much funds and not enough supply or stock, and it just keeps pushing share prices up.
Okay, so Craig, we talk about this dislocation between the local fund managers and the offshore fund managers when it comes to the retailers in South Africa. Foreign buyers very happy with the state of the South African consumer, thinks there's still lots of good things to come for them, and the local fund managers are a lot more hesitant around buying the retailers, obviously thinking they're expensive and thinking that this large amount of disposable income that consumers enjoy is going to come to an end, that it's cyclical. So perhaps you could just give us a bit more detail on why there are these dislocations both in the local market, and then we can turn our attention to the offshore market as well.
Yes, I think as you've mentioned, the consumer side of the economy has held up the local economy for much of the last little while. In fact, since the whole investment infrastructure boom kind of died off, the consumer's been propping everything up. And that has, as interest rates have come down, we've seen increased household expenditure, and that's boosted household spending and pushed up those retailers. So it has looked like a good part of the market to be in, and that's driven up prices, and PEs have gone up to levels that the local fund managers have become quite uncomfortable with historically. Now, we often have this debate in our office: should we get used to higher PEs? Is there a new normal, or is this just a bubble and we're going to be proven right later on? But I think it's maybe a bit of both, and these are the shares that have a bit of momentum. And I think if starting at growth, momentum, value, I think you have to go with it for a bit. We're still quite hesitant about going in at these kinds of levels. There's so many good shares, good companies putting out good results that are just at stratospheric valuations. And we look at the Aspens and the AVIs, great results, great companies, great dividends. But it's probably because there's a lack of other alternatives that we're seeing all the attention focused on those shares.
Okay, and when you referred to the multi-year highs that the likes of the S&P are enjoying, in that market, a little bit different. We know that companies in the US have been hoarding cash, and yet we're still seeing what suggests strong earnings growth through some of the major companies there. Is that a trick on the mind? Is it something that if a business like Johnson & Johnson is listed in New York and it's enjoying strong earnings growth, it might not be coming from the likes of the States, it's coming from other parts of the world? Or is there something that's fundamentally driving earnings in places like the USA?
I think overall we're seeing isolated cases of good earnings growth. I think if we look at the collective, and we've just had the recent reporting period, maybe it wasn't as bad as people thought, but the outlook seems quite poor on earnings, and earnings have come off quite sharply from where they were, as have our own. Our own earnings have been driven down largely by the miners. But I think the outlook and the recent history shows us that earnings have come off. Those companies have been cash flush, and I think it's not different to our own companies. I think our own companies are also quite cash flush. And that's why we're seeing a spate of special dividends, because these companies have got nothing better to do, no other alternatives to invest that money in. You don't want to buy your own shares because they're too expensive. There aren't any other alternatives. You've got a good cash flow, so we're seeing a lot of money coming back to shareholders.
Just coming in there, the earnings growth to a large extent, and the last bunch of quarters in the US, cost cutting has played a significant role. Then the question, of course, is how much more cost cutting can be done to support earnings, Craig?
And I think that's why we have a cautious outlook on the market at the moment. We've seen this little boost to share prices and to earnings, based on cost cutting, but you can only cut costs so much. You have to find other alternatives to boost the top line, to grow revenue, and those where the economies are slowing down all around the world, where we can't export because there's no other demand out there, earnings are going to come lower or just stagnate. And that's why we're a bit more cautious, and we say there's a bit of a disconnect between the economics and the market.
Okay, and in your presentation, the presentations you've been making to your clients and the arguments you've been making, you've talked about something that in the market that you've called something completely different or something very different. What does that translate to for expectations of investors in equity markets generally? What are you telling your clients to expect going forward?
I think we're telling them that they have to be cautious now. They mustn't expect a huge bull market now. They mustn't expect quantitative easing and all these other asset purchase programs by the big central banks to be the savior of the markets. A lot has been priced in advance for QE3. We're not so sure that there's going to be a great benefit after. And I liken all of this asset purchases and the quantitative easing to these programs where they put people on an island and they starve them, and then they have them one little challenge and they give them a big chocolate feast, and it's great while you're having it, but they're quite sick afterwards, and they're still starving for the next few days. So they haven't really sorted out the problem. And I think that's, for me, is quantitative easing and all these asset purchases. They will have some benefit, but I think we may be overplaying the benefit, particularly for the equity markets.
Okay.
Sticking with the equity market, in your presentation you point out that financial stocks on the JSE are looking expensive, but for the Aussie in general it's looking neutral, but probably on the downside you've got the resources stocks looking particularly cheap. So the question is this value or value trap? Should one be staying away if indeed the fundamentals aren't good, the real true tangible underlying stuff? Is there sufficient demand from China, for instance, for those commodities?
Yeah, I think we have also been caught a little bit in that value trap and looked at resources as the place in the market to be. Similarly, construction stocks, we've stayed away from those. Low PEs looks like value, but we could probably translate that to the resources part of the market as well. There has been a bit of a value trap there. It's cyclical. I think it will recover. In the longer term, we're commodity bulls. But I think in the short term, with the view that China's only going to grow at 7.5 this year and 7.5 next year, and who knows if we have to revise those numbers down again, it's unlikely that we're going to have a huge pick up in commodity prices in the short term. So there's still inventory destocking, and while that happens, the prices aren't going to pick up. What we're seeing now in platinum and gold is probably anticipation of more QE3 and also what's going on in the local mines, but that's very short term.
Mm-hmm.
Okay, so very tricky resources to try and figure out what is the normal level of demand going forward, but we're very familiar with the bad news. It's been around us for some time now. The whole Greek problem started in 2009. What are some of the signals that you'd look for to see that things are beginning to come right? We recently saw that the German Constitutional Court upheld the ability to fund the ESM, which I viewed as very positive. What are some of the triggers you'd think would be seen if things were to improve and maybe avoid the lost decade like we saw in the 1970s?
I think we have to see some positive response in the consumer space to show us that the health of the consumer and households is on a better footing. Bernanke looks at employment is quite key, and I think that's an indicator that we would look at. If we start seeing a bigger pickup in the jobs data, in improvement, unemployment rate coming down, I think that would be a positive sign. And around the world, and even just balanced budgets. That would be quite a positive sign, because once we get to a balanced budget state in a lot of those European countries that are suffering, we can then start thinking about more fiscal measures to keep that momentum going, and ultimately that will translate into earnings growth.
But we have to remember that we are in crisis globally, particularly the advanced economies, and it will take time for this crisis to resolve.
It's only going to take time, I think. Even looking at our forecast for US growth, we're looking for a bit of a pickup this year over last year, but our forecast for next year is a little bit lower again. So this is going to take years and years to sort itself out, and in that kind of environment, I don't think we can look at a huge bull market to come.
Okay, now George Soros wrote quite a lengthy and very interesting piece in the New York Book Review website of all places. I'm not sure why it ended up there, but it did. And in it he made the argument now that the problems that led to Europe as they stand were created by these peripheral countries borrowing too much money. But he makes the point that since then, some of the decisions that the German government have made in trying to sort out the euro has not helped the situation. In fact, it's made it worse. And he's got to the point where he says Germany needs to decide whether it's in and provide the funding that can allow the euro to continue to exist as it is, or they must actually leave the euro themselves and allow the peripheral countries to gain the benefit of having their currencies devalue and their economies become more competitive. What's your sort of take on the European situation and how they can go about getting this right?
I think we have been going and doing all the right things, and I suppose it's taken a lot of long nights and serious thinking to come up with all of these ideas and these policies in a situation that's never really arisen before. So I think they seem to be doing the right thing, the central bankers. Thankfully, the parliaments and governments agree that they need to save it. There is a concerted effort by all of those countries, it would seem, and things change on a day-to-day basis, but they all seem to have the collective view that they want to save the euro. But I think the key thing is it was one thing to have a monetary union, but without some kind of fiscal union or banking union, I can't say it was doomed to failure. We didn't have that kind of foresight. But we need them to be more of a collective on both the monetary side and the fiscal side.
And we're moving closer towards that announcement yesterday with the first steps towards the banking union. The plan's been laid out from July next year. The most significant economies will be included with that central banking supervision.
Yes, so we're heading in the right direction, but it's going to take time.
And does this, all the trouble in Europe, is that a place that you're looking to place client funds at this point in time? Do you find value in some of the European equity stocks?
I think, we don't look at individual stocks, but just in principle, I think that's what you have to do. We leave it to our partners at Barclays to do the stock selection. But I think overseas markets, that's a stock picking market, just as is our own. And with the earnings having come off in those markets, those PEs are very similar to ours, but it looks to me with the outlook in those markets, you can't just go and blindly buy an index and hope for the best, as you can't do here. As we talked about, our local Aussie is a story of two halves. You've got to go, I think, and in this case, be more of a stock picker.
I'd like to get your final word. We've got about a minute. So you said it's a stock picker's market. Be very careful. It's a difficult macro environment. So what's your final message to potential investors and current investors?
I think we can expect positive growth out of the equity market, considering that bonds and yields internationally and locally are at historical lows. They're probably going to stay there for some time. So, over the next couple of years, there may be a little more in bonds, but we're close to the bottom of the cycle. You want to be in equities, and I think they will benefit from being the preferred asset class. But given the economic fundamentals, they will dictate where the market goes. And given the slow economic fundamentals, it's going to be slow positive growth out of the equity market.
Warren, isn't it interesting, over all the decades, that message hasn't changed, that equities remain the preferred asset class?
Absolutely, and I think it's important that, while there is all this particular bad news coming from offshore, that investors take the opportunity to, if they have the inclination, to look at some of the individual stocks that are in Europe, and they're tagged as being European, but there's many, like Banco Santander, that have great global franchises and that you can pick up with good balance sheets. But of course, there's always uncertainty, and I think the key thing is to have advisors that remind you that these things do come to pass and things will change and improve in the future.
Absolutely.
Staying positive.